Happy New Year,
Hi,
Joseph.
Happy New Year, Dale. Good to see you. Thanks for inviting me.
Yeah, I see you have some new things happening, new offerings. I think I caught it on your stream. You want to tell the crowd about what else you're doing besides your courses before we get to the markets?
Sure. I have a weekly newsletter called at fedguy.com where I talk about my views on the markets. I also have a market portfolio where I illustrate how I'm implementing these views in case anyone is interested in how I am allocating right now. So that's the new thing this year.
Cool.
And of course, every week I also have videos on YouTube at my channel, Joseph Wing, discussing what happened in the markets.
All right. So plenty of content. And if you're confused about what's going on with rates, Joseph will give you some deeper understanding from having been on the desk and been in that institution, not a institution, but the institution of the Fed. They may need some shrinks before this is over. So, top of mind for you going into red sweep and tariffs coming up, and you know, this is the first time in my career that I remember the Fed starting an easing cycle and the market rebelling against it in this way. Uh, Tell us what's going on through your eyes, Joe.
So I think we're at a turning point here when it comes to rates. And I look at the world uh, as a building block, first and foremost, what rates are. And from there, you can build on to other assets like commodities, FX, and equities.
Okay.
So as you noted, the 10-year yield has been rising, even though the Fed has been cutting rates. And that is largely because the market has been steadily pricing out Fed cuts.
Right.
So um, we were pricing in as many as five cuts this year, just a couple months ago. Today, we're only pricing in one cut. And that is actually a lot more than the Fed's own dot plot, which guided towards two cuts this year. And so the 10-year yield has been rising because the market is becoming increasingly hawkish. They think that the Fed just is not going to cut. I think that is not the right way to look at this. And I think the market is really getting ahead of itself. So with the 10-year yield here at around 5%, it's very clearly exerting downward pressure on economic activity. And you can
Yeah.
see this through housing. If you look at the
Yeah.
earnings call of Lennar, they'll tell you that things are not good. They had a huge miss in
Got
their
it.
units delivered. If you
There
look
you
at the
go, buddy.
home
Ask and you
builders,
shall receive. Yeah, all of them are. They've
yeah,
been
the
getting
home builder
killed.
stocks, they're just getting crushed.
Yeah.
And if you look at what's happening abroad, you can see that U.S. Treasury yields are dragging up foreign yields, strengthening the dollar, and that's all tightening global financial conditions and pushing a lot of other economies that haven't been doing as well into recession. And of course, you can see that it's having a very clear impact on equity markets. So I think
Yeah.
we're topping here in the 10-year yield.
Okay.
And going forward, I think that it's going to be more obvious that this is having an impact on the economy, and then the market will begin to price in more Fed cuts again.
Okay.
Now, this being my
All right.
core view, that has direct implications on things like FX. I think the
Right.
dollar is definitely, at least for the moment, topping here for a bit. As
I'm with you.
yields come down, you'll see that interest rate differential narrow a bit, and you can
Right.
see the dollar, I think, uh, come off the come off the burner for a bit. I
Okay.
think for some currency pairs that could be significant since you really do have a lot of people long the dollar right now. So I think
Yeah.
some degree of
I would say the most hated currency would be euro. That's where you get all the bad news. Is it possible the euro is underowned, dramatically underowned? I remember talking to Andy Constant, I don't know, about 5 months ago, and he said it was starting to become underowned, and that's when it was much higher. So, what's your favorite fiat? I
well,
guess the
obviously the
dollar.
dollar is still I think is still much better than the other fiat currencies. It's just that I think we're just really stretched here given the
Okay.
rates. What I'd like to see is the yields come down, market price in more Fed cuts, see the dollar weaken a bit, and then I would go back and buy the dollar. I just think this is more of a,
Okay.
kind of a medium term, okay, I don't know, short to
Yeah.
medium term reversal. But I think if you have a longer time horizon, I think the dollar is going to strengthen against these other currencies, including the euro.
Okay.
Now the euro, I mean, when I look at Europe, it's very difficult to have a to be very constructive on Euroland since they're just not doing very well. There's no growth there, and at the same time, there doesn't seem to be any solutions to help that. It looks like they're going to miss out again on the so they missed out on the 1990s tech boom, and it looks like they're missing out on AI again. And I don't think there's any political movement there to fix that. So
Okay,
I
how
think
about
that's
the dollar
difficult.
against yen, which if it's pretty
Okay.
tightly correlated to yields. So if you're looking for a correction in yields here,
I
or
think
maybe,
I am most bearish USD JPY, so very bullish the
yeah,
yen. I
okay,
think right now we could have really big moves lower in the USD JPY, not just because the interest rate differential, but because the incoming administration is very
yeah,
clear that they want to have a weaker dollar. I mean, they don't want to lose reserve currency status, but they want the dollar to be weak enough to help with exports.
right,
Now,
all right,
as Trump and his team go about and try to do this, other countries will respond. I don't think the Europeans are going to be willingly to, strengthen their currency. I don't think the Canadians or the Chinese will. But one country that has always been, I think, very receptive to US guidance is Japan. And this is true as early as the 1980s when, during the Plaza Accord, the
yeah.
US basically strong armed Japan into strengthening their currency in a huge way. So I think that is all still true. The Japanese are still on very good terms with the US and still highly dependent upon the US for defense. And so they just have a long history of listening to what the US government says. And I
They're
think
not
that
happy about the U.S. steel deal, are they?
uh, you know, maybe Trump would do something about that, right? That's something that we
Yeah.
can have changes in the U.S. administration.
Well, he'll
So
do something about everything.
one thing I would also add is that I think in Japan, and as someone else discussed on this call, is also having some problems with sentiment being impacted by weak currency. So the people are unhappy there. And also inflation does seem to be sustainably above the 2% target of the BOJ. And so I think they would also be happy to strengthen their currency a bit since that would be happy for that would be good for the political class over there in Japan. And I see someone in the comments noted that Trump doesn't like the deal as well. Well, we'll see. I haven't really looked
Yeah,
into the details of that, but
yeah.
if Trump and Biden can agree on something, I think that's that's surprising.
I wanted to ask you, should this narrative play out? And I've been having a hard time, you know, with the puzzle pieces of because I am looking for a weaker dollar and lower yields, and well, you know, a weaker dollar. Do you think that that's going to translate, pull back in yield soften and the dollar soften, translate into stopping this risk off move, or it's going to happen because of risk off?
So I think that right now, it depends on your time frame. It looks like, I mean, talking from listening to the options people, it looks like that we could be due for a bounce. And I mean, if you look at VIX above 20, you can easily see some kind of volatility crush here, sending stocks, just for a
Bounce
for
again.
rebound higher. Now, throughout the year, I'm very negative on U.S. equity markets. I think that we have a lot lower to go. Now, the reason I say
Okay.
this is because, one, as Trump comes into office, now I've studied Trump for many years and I've looked closely on the incoming economic team that he has, listened to their podcasts and their writings and so forth. And I think he really is going to try to shake up the world, put on tariffs, try to raise more money from tariffs, and also try to reshape trade flows. And that all that is going to be very, very disruptive to business.
Yeah.
And I think just as importantly, I think that there's a lot of foreign money in the US simply because the US stock market has been doing very well. And the US is kind of where you need to go if you want to have exposure to all this AI stuff. And as the dollar weakens, a lot of these foreigners are just going to get out simply because they don't want to have these currency losses. For them, it's been really good on the way up, strengthening dollar, higher equity prices, double play. Now on the way
Right.
down, I think they're going to have to get out. And I think that we could have a pretty big decline in the equity market this year. Again, it's not like we're going to go to the Great Depression or some kind of financial crisis or anything like that. But I think we'll have a pretty sizable decline this
How
year.
about 4,900 S&Ps?
I could see 5,000, yeah, somewhere
Okay.
around there.
All right. Maybe it happens in a hurry the first quarter, and then some of the policies that he starts to get through, we get a big recovery after the first quarter. Could that be in the
Yeah,
cards?
totally possible. I
Yeah.
do think that we're going to have, so again, looking at this from a policy perspective, if you are President Trump, you know that you have your next midterm elections in 2 years.
Yeah.
You know you want to
Right.
do big changes, right? The way you do
Yeah.
this is obviously front loaded. Do it now. Make sure all the commotion is out, and then next year, right? You ride the recovery higher. Then everyone feels better. You go into midterm elections. Yeah, the stock market declined a lot last year, but look how much higher it is today, right? So
Yeah.
that seems
All
to be
right.
a very good playbook. And first 100 days are obviously when presidents usually do their big moves.
Yeah. Well, I wish that we had 100 days to work on the debt ceiling, but we don't. And it seems like they want to get the grand package through, including the debt ceiling. Any concerns about during these early days that there could be any upset? And then something else, Joseph, no one's talking about. Remember before the election, how everyone was very fearful of a port strike that was not settled, only delayed. And I think we're in that zone now to see whether or not that happens. That could be a supply chain issue and have people thinking about inflation as well, right?
That could be. So I don't know enough about that to comment. I mean, it seems like the
Yeah.
government can always do something to bribe them. So those things always,
All right. We'll
they
see.
often dissipate.
Yeah. Okay.
Uh, the
And what about debt ceiling?
so the debt ceiling, it can have some temporary disruptions, especially about the plumbing of the financial system. Uh,
Yeah, it's
I
tough
just don't know
tough to
enough about
say.
the politics to see
Yeah.
everything will go through. So
So do you agree?
those things are, yeah.
Yeah. Do you agree with me that what we know we don't know with
Yeah, I
how things are
don't.
going to be in a week or so?
Yeah, these I don't know what the dynamics of the relationships they are in the new political players and so forth. So
Yeah.
I can't comment on that.
Yeah, it's going to take some time. So, okay, so um, takeaway is pretty bullish yen, bearish US dollar yen. As we speak, the dollar started coming off here, Joseph, and you just think it's going to be a correction, nothing major like we won't revisit par again
Or for the euro, you mean?
for Dixie.
So where are we now? I usually look at the pairs rather than Dixie.
Okay, so euro. Will we see what could we see 112 again? Because
Nah,
down
I don't know.
here,
That's a lot. I don't know.
is it?
I mean,
Okay.
I could. So listen, looks like we're having some kind of support resistance around 105. So we could break above there, but
Okay, yeah.
I think that just a medium term view, it does seem like the dollar is just the U.S. economy is doing much better, and I think that gap between the U.S. and the rest of the world has been widening the past decade simply because
Yeah.
the U.S. just has a lot more productivity, which you can think of as technology, and it looks like the trend here, a couple trends, right? One is that the U.S. is has AI and other
Oh,
countries
okay.
not so much. The second is that other countries can't even have AI because, like in Euroland, they don't have enough energy, right? One of the big trends in the US is that all this AI stuff requires a lot of electricity, so everyone is building,
Yeah.
new power
Natural
plants,
gas.
nuclear like stuff like that.
Yeah.
You don't even have that in Euroland, and right now, when the weather is cold, you can see gas prices surging,
Yeah.
and that's a political decision, right? Some countries don't like nuclear. Some countries they don't want to buy gas from some other countries and so forth. So that suggests to me that even if they were to have AI, they would not have the infrastructure to support that. And
Okay.
that
All right.
productivity gap that we've already seen widen between US and Europe over the past decade, and it's notably wider today than it was around the financial crisis. That's probably going to continue.
Okay, that's it. I just went to your website so that we could talk about some of the things. So you want to give me a little bit more? I think we've covered this is really the topic that we've been talking about, shifting flows,
Oh
right?
yeah.
Okay,
Yeah,
so
and today I
go
will
ahead.
talk about my argument why yields are peaking around here. Around, I think it's really hard for the 10-year to be, above 5% for now. Eventually, I think that we are on a path where I think secularly, globally, yields are going to go higher. Inflation will be a bit higher than before, but it's not like it all happens in one day.
Okay. Um, Interesting. So something I noticed Friday that was a little bit of a market tell was when after the number, the 10-year never gave it up, and it actually, is tried to make some new highs early in the week. The long end, which everyone's been shunning, hardly sold off Friday. But I wanted to ask you about this chart before we go, because this level here at 85 on TLT, if you look left, is huge. So we should get a bounce from here, maybe back to 90 or so, maybe 92. But if we close under 85 here, Joseph, just technically, um, I have targets down here. Could you see TLT sometime this year trading at 72, 70
I
in
don't
that
know.
range?
Well, I mean, what is that in yields? Is that above 5% on the 10-year?
Probably
I think that's really
yeah,
hard to sustain, right? So, I mean,
not
this is self.
sustain, get there.
I don't know. This is kind of I look at this as a self-correcting thing, right? Yields go up. What happens? Equities tank, economy tanks. Okay, then
Uh,
people go and run back for safety in yields. One other
okay,
thing I'll note is that there's a lot of tools the government has to lower longer dated interest rates. One thing, for example, that I think they will do is they will change regulations, the banking regulations, either be taking off the asset cap of Wells Fargo, either it be adjusting the leverage ratio to encourage banks to buy more treasuries. And you can unleash like hundreds of billions of dollars in demand just by doing these simple things. So
yeah, okay.
these guys, this stuff, listen, yields, this is just numbers in a database. Government has a lot of influence over it.
Okay. And first time I've heard you pretty bearish about the outlook for equities over a longer period of time.
Yeah,
So,
last year was all about to crash up, and we did crash
yeah,
up. This year,
yeah,
I think we'll have a whoosh sometime this year.
okay. Um, uh, do you think that we're having a rotation out of tech, Mag 7 stocks and a rotation into perhaps commodity stocks? Oil's been acting better. Um, the miners have been under pressure for a long time. Uh, the industrials have been under pressure. Could this uh, IWM, small caps, could that be a place to accumulate on weakness? Where do you think the rotation is going to go? Because it's illegal to go to cash. You
Ha
have
ha
to
ha.
rotate. You have to rotate from one sector to another. Where's the money going to flow from big tech and
So
people?
I think we have to be careful when we think about things on a sector basis,
Okay.
because a lot of times, we want to think that there are a lot of investors who are allocating between sectors and so forth. But a lot of times, you have greater forces at play. For example, a very well-known trade over the past year was the dispersion trade, where because of options activity, the S&P 500 was pinned, and so that
Yeah.
created a lot of dispersion and volatility, where people thought that you were, outperformance of the Max 7 and so forth, whereas it was largely driven by these dispersion trades, which were pinned by greater option flows. So I'm not really
Okay.
sure there are that many people in the market that are allocating by sector. It seems like when people buy stocks. It's really like an index level basis. So
Yeah.
so that's how I think about that. Now, with
Well,
respect to commodities like miners, I've been looking at miners too, and what really surprises me is that they just go down and down and down every day. Now,
yeah.
in theory, I'd like to say that we are in a world where we could have, for the next 10 years, higher inflation than in the past. And so, in theory, commodities would be the place to be. But you just can't see that in the miners at all. They just get
Yeah.
sold every day, and it looks really terrible. I
It's the
would like
most
to buy.
contrarian trade on the board because you know what? Physical gold bulls and silver bulls, which you could question silver bulls right now. They hate miners. There isn't anyone that likes miners. Even gold bulls, okay, and silver bulls hate the miners.
For good reason, I think, for good reason. Anyone who's bought a gold and
They're
silver miner knows that
the
it's not a good
P&L.
investment.
Okay.
So I was more referring
Good.
to the diversified miners like Vale or Rio or BHP. I would
Yeah, all
like to
right.
buy those uh,
Freeport.
a- after the whoosh, should it happen. I would like to buy those. And aluminum too. I think aluminum is something that we're going to have to need if we have to
Mhm.
rebuild the grid, which we will have to rebuild the grid eventually, because I think the future really is electrification. It doesn't mean that we're all going to be using wind and solar, but I think we definitely will be having a lot more need for electricity, probably generated by nuclear in the future. And so, in order to rebuild the entire grid, we're going to
Well, a
need a
lot of
lot of
people are
aluminum.
saying it's nat gas is the bridge, and
Yeah, yeah.
we've had
And
had a real nice move there.
yes, and well, part of it because it's very cold, and
Yeah,
that gas is a heating gas for a lot of people globally. Also, I think that there's some commentary about maybe things would change after Trudeau steps down. In Canada right now, if you were to buy some of their uh, natural gas, their energy companies in CAD, if you have going forward, let's say the
oh,
dollar weakens a
interesting.
bit, you could have a double
Yeah,
play where you could have appreciation. You can win by the Canadian dollar appreciating, and
yeah,
also the energy companies increasing due to higher energy prices. I think right now some of the oil prices are due to geopolitical risk. We did have that increased noise
yeah.
about Russian sanctions, but that we'll see how that plays out.
All right. So, you said double play a few times during this interview. So, what position did you play? Were you a shortstop?
Yeah, so I own a lot of so looking at USD CAD, I can see that we are really at times, at 1.1 That's historically
Yeah.
that's oftentimes where we reverse. We could go even higher. I don't know, but I think this is a good level. So I bought a whole bunch of CAD and I use that to buy dividend stocks in the natural resources sector in on the Toronto Stock Exchange.
Oh, well, thanks for sharing that. There you go. Joseph, not just talking about things, but laying out what he has skin in the game. And thanks for doing that, Joseph. And I want to thank you for all the years we've been able to talk together and you edify the FACE community. And we all want to thank you.
Thanks so much for having me, guys. Happy trading.
Yeah, good hunting, Joseph. See you in the spring. And everyone, at the minimum, follow Joseph on X at FedGuy12 and go to his website and check out his letter. I'm going to be checking this out because I get some stuff from Joseph, and it always makes me think. And when you have people like Joseph that you can read and we get to talk to them, that keeping an open mind will keep our accounts open. So,
All right, great, guys.
all
See you later.
right, see you, Joseph. All right, everyone, that's a wrap. Hope you enjoyed it. Could join the team in about 18 minutes on the morning edge. Trying to get a little bounce in euro. Dollar coming off a little bit. Yen's bouncing. So, uh, I don't know. I know everyone hates the euro. So I just think that I agree with Joseph. I just think there might be more duration to the downside because I think that we're going to take out par sometime this year. Okay, over 112, I'll throw in the towel on being a dollar bear. But until that time, I think we're set up in here, like here. So remember, don't just count your pips, count your blessings. And we'll see you tomorrow for Turnaround Tuesday. Adios, everyone. Have a great day.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.